without any further ado, I thought I'd skip on to our first session. The first session of the morning is really designed to look at the economic impact of the fintech revolution, the alternative finance revolution. And I suppose it's appropriate that we start with the biggest single impact, which is the global impact on the funding of small businesses. Because I do think that it's very interesting. I had a story recently that there was a research report done by a bunch of guys out in, I think, in Australia, and they looked at the degree to which small businesses wanted credit. And what they all sort of turned around and said, they really did want credit. They needed credit to expand, but they were very reluctant to ask the mainstream financial services outfits for credit. They were worried about, from the big banks, their ability to lend. And there was this massive pent-up demand for small credit funding. But there was this also massive pent-up suspicion with many of the existing providers. And it's outfits like Funding Circle, who I think are just currently doing the IPO roadshow at the moment, has emerged as probably one of the biggest single new global disruptors within the SME funding space. So to talk about some of those issues and how that's impacted on the wider economy, we've got Samir Desai, from a co-founder of Funding Circle, and Ed Robinson from Bloomberg News to chat about some of those issues and many more. Anyway, enough of me gabbling. I'm going to hand over to my two colleagues who are busily walking down the stage now. So Ed and Samir, thank you.
Good morning, everyone. Welcome to the AltFi conference. My name is Edward Robinson. I'm a senior writer with Bloomberg News. I've been covering the fintech space, the peer-to-peer lending space, for about 4 or 5 years now here in London. And one of the first stories that I ever worked on was about Samir Desai and James Makings and Andrew Mullinger and Funding Circle. And it's my pleasure to have Samir with us here today. Funding Circle, as you know, caters to the SME space. And it's just hard to believe, Samir, that just 9 years ago, 8 years ago, you and James and Andrew were sitting in a pub in, Fitzrovia somewhere, and came up with the idea for a peer-to-peer platform that would cater to the SME space, because at the time, that segment was really underserved by banks. And it's been several years that you've developed this company, you've built it, and now Funding Circle is preparing for an IPO. Just share with us, if you could, what are your big takeaways, just looking back over the last few years, on how you developed this asset class in the SME space, and how you came to manage the risk, the credit risk in that space?
Sure. So, for those who don't know, we started Funding Circle. James, Andy, and I quit our jobs in 2009. And the idea was quite simple, which is we saw that small businesses were very underserved by banks. It takes a long time to get a small business loan. It can be 15 to 20 weeks. There's no price transparency. And we also felt there was a big disconnect between how much banks cared about small business lending, where it's about £70 billion a year in the UK. But if you compare that to, say, the balance sheet of a bank like Barclays, Lloyds, it's $1.5 trillion. It was actually quite a small part of what they did, but it was quite a big thing for society. So small businesses make up 50% of private sector employment, 60% of GDP. At the same time, we saw that investors were getting low returns on their money. You were increasingly seeing the emergence of mid-corporate lending funds who were lending to medium-sized businesses, typically doing 50, £100 million loans. And that market now, by some estimates, is 30 to 40% of mid-corporate lending being done by the BlackRocks, Apollos, Ares of the world. So just thought, could we bring all these disaffected parties together and try and create a better deal for both sides? So we launched in 2010 in the UK. We since expanded the business in 2013 to the US. So we saw that people were starting to replicate the model in the US. We just felt we couldn't really live with ourselves unless we gave it a go, which we did. And subsequently into continental Europe in 2015 as well, in Germany, Netherlands. And if you fast forward to today, we've originated over £4 billion of loans through our platform. If you look at both flow, so 1.75 billion of that came last year alone. So if you look at the flow of new loans, that 1.75 billion, and also the stock of outstanding loans, so we have about 2.1 billion pounds of loans under management. We think we're the largest online small business loan provider in the world. It's bigger than any American or other player. And that's pretty exciting. I think if you asked us many years ago, we would have, we thought that we could eventually, become good at one niche, maybe dentist lending or something like that. We certainly didn't think we could build the platform internationally. But in terms of some of the stuff we really learned, this is ultimately a data business. There isn't much data on small business lending. We typically see lower performance in the first 2 years in every market we enter. But that's because, it's hard. There isn't just a consumer credit score or some magic score you can pull and do all right. So you have to build these vast data sets, but actually that becomes a huge competitive advantage over time because investors want to come to the place with the most loans, the most track record, especially large institutions. Borrowers want to come to the place where they can get the fastest, lowest cost loan. So you get pretty powerful network effects with the business as it scales over time. And the other interesting thing we found is that being global is actually a huge advantage for us as a business. Beyond just having another market, getting more corporate profitability from it, actually 50% of the funding, the lending that goes through Funding Circle is done by investors that purchase loans in more than one geography, which creates huge advantages against local players, we feel. So, both of those things are not things I thought would probably be the things that would really make the business, but I would say those are the ones we've seen emerge.
So building out the data sets, the way institutions, investors, the larger investors have come in and looked at global markets and they're able to compare data sets in these different markets. Very interesting. In June of 2016, when the referendum on Brexit came around, there was a lot of anxiety in the UK space. I mean, remember back to that time, the UK peer-to-peer lending story was really hot. You had Zopa, RateSetter, Market Invoice, Funding Circle, and it seemed to be growing at, shall we say, a much wiser pace than, say, what we were seeing in the US. And you had the regulator here who was taking a very enlightened approach to kind of building out peer-to-peer, and then all of a sudden comes Brexit out of left field. And I remember there was a lot of anxiety in the space around what kind of economic effects there would be in both the SME as well as the consumer markets. And but since then, we've seen a strange thing, which is it doesn't seem to have been a factor at all. I mean, your volumes have continued to grow at a very healthy rate, and we've seen that with some of the other platforms as well. Why do you think that is, Samir? Why did Brexit not derail peer-to-peer lending in the UK?
Well, I mean, I suppose it hasn't fully happened yet, but I think, if you look at what banks do, again, they don't really care about small business lending. It's a small part of what they do. It's become a reasonably big PR story recently, but it doesn't move the needle in terms of if Barclays or Lloyds or someone was to take 10% more share of the market, it would have a pretty negligible effect on their balance sheet, on their returns. So, with that in mind, it is an area that gets the least attention, and when events happen like Brexit or recessions or things like that, banks pull back a lot more than they would ordinarily. They make most of their money from things like mortgages, credit cards, payments like that, payment services. So, at the time, we definitely saw banks pulling back. Equally, the assets being generated in UK platforms have very high loss coverage relative to the average across the US, Europe, other markets. So what I mean by that is they can sustain a much higher increase in losses than you would see in others. So what we saw from investors was, some concern. We talked them through it. We talked very much about how, on the margins we were tightening as well. But actually, those kind of, pretty much, I don't think any investor stopped lending after Brexit. And those two effects together meant that actually we were able to increase the share that we had of the market.
I see. One of the things we've seen in the evolution of this marketplace over the last few years is the balance between the peer-to-peer side and increasing shifts to the balance sheet side. We see platforms increasingly starting to want to use their balance sheet in addition to kind of matching investors and retail investors and borrowers. And this is kind of happening in tandem with more institutions coming on and wanting to play in this space. Share with us, if you could, Samir, what your thoughts are on this model shift. Would you ever contemplate, for instance, using a balance sheet at Funding Circle to fund loans in addition to the matching that you're doing?
No, I mean, it's a bit of a loaded question. You know, I've been very consistent on this over a number of years. You know, I do think that the pure play platform model is a superior model to a balance sheet, or hybrid as it's called, you know, where people do a bit of balance sheet lending. You know, if you look at Funding Circle, of the 2.1 billion pounds of loans under management we had at the end of last year, I think we had about 3 million pounds on our balance sheet, and of that, you know, we have to cure loans in the US for a few days before we sell them on to investors. So, you know, we've stuck pretty rigidly to this philosophical view, and the reason is, you know, I kind of think that the only way you can get true alignment is to not do these loans. From an investor perspective, especially during the financial crisis, you saw in securitizations underperformance of securitizations, or certain securitizations, relative to the loans the banks were holding on their own balance sheet. You know, when times are tough, how do investors know that we're not just keeping all the good loans for ourselves, giving the bad ones to other investors? And I also think the platform model allows you to do things that you can't do if you're a balance sheet. So, for instance, in SME lending, there are very high capital requirements against loans the banks do. You know, you typically don't have much collateral in these loans. You can't get the relief that banks get against mortgages, things like that. That means that platforms can serve a much wider group of businesses than a balance sheet lender or a bank can. You know, we estimate it's in the range of 20 to 40% more businesses than if you were doing loans on balance sheet. That allows you to do pretty sophisticated things with pricing. You can actually drive down costs because you can accept more loans. You can drive down price below, I think, what banks and other providers can actually charge. So I think the model is superior. It requires vast amounts of scale, which, you know, even now I don't think we're fully there yet. But, you know, I do think it's a much better way of attacking the problem. Now, the only caveat I would say is that we've approached it very much from the small business lending perspective. In consumer lending, you know, I know a lot of people are becoming banks or contemplating that. You know, I see that in the States, I see it here, you know, obviously know all these people. So maybe there is something in consumer lending that makes it worthwhile to be a bank. Maybe it's more commoditized, I don't know. But certainly from our perspective, we've been pretty consistent on this. And the other example I'd use is, you know, there are these huge mid-corporate lending funds, people with tens, hundreds of billions now being managed in funds, and they're not doing balance sheet. You know, they're not lending money themselves. So you can get to these very large amounts of, you know, large levels of scale with a capital efficient model that ultimately makes you a better intermediary.
So to use the balance sheet would be a constraint in the SME space. It wouldn't allow you to scale as heavily, and yeah, just the cost that you would incur as a result of that model, you just feel are just too constraining.
Yeah, I just think it creates misalignment. I think by being a lender ourselves, we're basically saying we're more on the lender side than necessarily clearing. And I think, you know, look, you know, we could convert ourselves into a balance sheet. We've got more than enough money. We could borrow, you know, take some deposits, be super profitable. But I just don't think it's. I don't think in the long run that's the right model for really generating the most impact and really helping small businesses.
And you've seen over the years the SME space from the banking side too, and how they've What are the banks doing on this right now? I mean, they've seen Funding Circle, they've seen what other platforms have done in the space using technology, using a platform model. Do you anticipate that the banks are going to move into your turf in a stronger way? Do you anticipate more competition coming from the incumbents?
Yeah, I mean, I think so. I think you're going to see experiences improve, but one of the things we've learned about this space, which is quite interesting, is banks and actually most other large merchant networks, the PayPals, Amazons, Squares of the world, who are doing a bit more now, they only really lend to their own customers. So if you're Barclays, you're Lloyds, you have your base of customers, you've got their bank data, you lend to them, but you don't typically go outside. And if you do try and go outside, you use it as a way of getting someone to move all their business across. So what we've kind of learned over the last few years is no one has actually had any experience of trying to go outside their walled garden. It's the same with the Squares, the PayPals. Inside the walled garden, life is beautiful. You've got all the data you could possibly imagine. Outside in the real world, it's cold and dark, and you've got to do years and years of lending before you get the data. So, will banks create better experiences for their existing customers? I think they will. But for them to learn how to acquire new customers in the real world is going to take a long time. And frankly, we've been doing this for 8 years now, and we've learned a hell of a lot in terms of the same borrower can come from a different channel, different time of day, things like that, completely different risk. These are things that everyone else is going to have to learn. So, outside of existing customers, I suppose we're the incumbent. We've got all the advantage. So we feel very comfortable competing in that world. And at the end of the day, I think businesses are just going to want to have something independent. When we survey businesses, they talk a lot about, okay, we want to trust the brand, we want to get a good price. But ultimately, one of the key things that comes up is I want to have independence from my bank. I don't want all my business with one person, especially in a GRG, RBS world where that provider can shut down your business if you don't make a loan payment. So I think there's ample room for platforms to be a pretty substantial part of the business, this market.
Now, Funding Circle, you have businesses in Germany and the Netherlands. What's your outlook for the peer-to-peer lending model, in particular for SMEs on the continent?
I'm really bullish, actually. I think if you look at our business in continental Europe, it's, I think at the end of last year, we were doing close to 20 million a month of new origination. We're seeing much lower acquisition costs than we see in other markets. And people told us, don't go to Germany. There's money on the streets. Everyone can get a loan. The reality is that is true for Mittelstand, medium-sized companies. But actually, at the small end, you get exactly the same effects that you get in all the markets. It's been very interesting for us if you compare, say, the UK and Netherlands, very concentrated banking markets, typically 3 or 4 banks control the market, to, say, the US, Germany, where actually it's very fragmented, thousands of banks. We see the same effects, which is these kind of sub 500k loans are really pretty underserved. So we're very bullish on continental Europe. We're starting to get a lot more investor appetite now because we're able to show more and more track record. And I think that's also exciting for some of the other large markets in continental Europe as well.
And in U.S., how is the U.S. Compare and contrast with the U.K. market when it comes to the challenges and opportunities of running your platform there?
Yes, the U.S. market was significantly more competitive than we saw in any other space. And I think what's interesting in the U.S. model is a lot of people raise a lot of money very quickly. So, the people we were competing with had raised tens of millions of dollars. But what's also interesting about the US market is it kind of clears people out very, very fast as well. So, and as you know, there were some industry issues in 2016. So, actually, we've originated over $1 billion in the US. We're the largest platform, we think, by far. And you're starting to see that classic network effect game kick in. Now that we've got to this kind of level of scale, we did over $500 million last year alone. We're starting to get a lot of investors interested. We've got a long track record. So I think it's one of those things where, you just need to be patient in the market, wait for it to develop, and then, it follows exactly the same dynamics.
We have some questions from the floor. This is an interesting one here. Is we've watched over the last couple of years the development of the so-called neobanks, Atom Bank, Starling, Tandem. I think Ricky Knox is going to be here today. What opportunities, Samir, do you see for customers in Funding Circle as digital challenger banks enter the SME space? I mean, right now these banks are very focused on building out their current account business and bringing on as many clients and working that card business. But if they eventually start branching into lending in a very big way, what kind of challenge would they pose?
Well, I mean, I'm going to talk my own shop, to be honest, but I think in SME lending, you just need to do lending. The fact that someone has got some customers that use a bank account. I mean, if I look at my wallet, I've got all these cards in my wallet, actually, Tandem, Monzo, and they're very good, so don't get me wrong, but does that mean I'm going to just immediately now decide to do all my borrowing through one of these guys? No, I'm going to go around, I'm going to shop around. And in a world of PSD2, open banking, I'm not convinced that you need to do the dumb infrastructure stuff. Like, why do the current account, take all that cost, do all that stuff, when, frankly, you can seamlessly pull that data. Even today, we can pass 60-70% of bank statements automatically from just uploads, which takes a customer a minute or two to do. So, I don't know, I'm not super convinced that there's going to be any competitive advantage from owning the customer in the actual lending side of things. I think what is interesting is turning these types of providers into marketplaces. I quite like the idea of that, or perhaps serving certain niches. I've got a Tandem credit card. I don't know if Ricky's here. I think it's quite good. But I don't know. Let's see how it all develops. But I feel pretty confident of being able to defend ourselves against someone who's not done any lending or hasn't got really any data advantage.
Another question for the floor is, how will Funding Circle's public listing change your scalability, your strategic plan?
Well, I mean, we've not confirmed that we're doing an IPO or not. What we've always said is, we do think being a public company at some point will be an advantage for the business. Ultimately, these businesses are about trust. What you saw after Lending Club listed was a significant increase in certain types of institutions participating on the platform, banks, insurers, people like that. So we'd like to see more of that. But ultimately, what we've learned with this business is, there's all, you can get super good at direct marketing and all this and acquisition and everything, but ultimately you just need to build a brand that people trust and want to work with. For all the marketing we do, on an unprompted basis, if you ask a small business, where do you want to go for a loan? 30% will say, Barclays, RBS, someone like that, and 4% will say Funding Circle. And we're planning to invest a fair amount of money to change that. So I'm excited for raising more money, whether that's privately or publicly, and putting it behind, really trying to change this bank first mentality. Because I actually think it can be done. Whatever you say about Wonga, bad things, good things. Wonga at one stage, pre all their problems, had higher awareness than actually banks. So there is a way to cut through and create brands that people and businesses want to work with.
Yeah, that's often talked to. I mean, it's become a cliche in the space to talk about the stickiness of the incumbent banks and how even if you don't particularly like your current bank, it's very hard for people to leave it. But just speak to that idea of, I mean, you've had 8 years now of running this firm and working on building its brand and building trust in the marketplace. Where do you think you are in terms of really establishing that a kind of prestige or your reputation?
I think it's very early still for everyone. Even a SoFi that's been spending a lot more than any of us is starting to push some of the boundaries. But if you take a step back, what Funding Circle really is a repeat customer platform. 40% of our revenue actually comes from existing customers. The vast majority of the lending is from lenders or customers that have been with us for a long time. And all technology or platform type businesses are essentially about repeat. That's what really defines them, I think. Now, 94% of borrowers tell us they would always come back to Funding Circle first for a loan in the future once they've taken a loan. So once they experience this way of borrowing, they pretty much never want to go back. So, we know the customer experience is very good. We know that when we show someone a TV ad and they've never heard of us before, they're significant multiples more likely to actually take out a loan from us in the future. So if you kind of believe in that business model, which I do, and you understand that actually repeat customers have 3 times as high margin as initial customers, why wouldn't you spend a fair amount of money at the moment to actually increase brand awareness to try and get people to trust you? So I think the core products are very good. I think you just need to just push the boundaries. But there are very clear examples of people doing that.
So when you look at barriers to entry for potential rivals, whether they're other startups, whether they're existing banks, whether it's Goldman Sachs, who plans to come and do consumer, they're bringing Marcus to the UK at some point in the future. You've got 2 real powerful things in your favor. On the one, you've got the data sets that you were talking about earlier. You've built these data sets, you know the market, priced it, measured the risk, but you've also now got brand.
Yeah, I mean, I think it's ultimately, it's about data, so being able to actually credit assess these businesses accurately, price them accurately. It's about the network effects that you get from that, particularly on the investor side. Investors want to come to the place with the most track record, most loans. But also on the borrower side, the repeat rates on borrowers are very, very stable. That existing book of business is very profitable, very stable. And then the final bit is brand. But, look, on the consumer side, there are multiple examples in the US or other markets where Goldman Sachs turns up and does $1 billion in 10 seconds. No one has ever done that in small business lending. And, if you could, we would be trying to do it. The data is very thin. You have to be in a market for a number of years to actually develop the data sets, especially if you're doing term loans where the average length might be 45 months. I think it's a much more defensible space than what you see on the consumer side.
I see. How are we doing on time? Okay, good. Let's see what else we got. The third-party digital banking marketplaces. There's a question here, Samir, that will Funding Circle look to follow its competitors through participation in third-party digital banking marketplaces? What do you make of that?
Yeah, I don't know. We'll have to see, really. We prefer to control the customer experience, to be honest. We prefer to have things direct, particularly because repeat customers, all the reasons I talked about, repeat customers are much more profitable. So I think it's reasonably unlikely, but let's see. We might be forced to if people are so successful. They have a huge amount of small businesses signed up, but I personally don't think you need to, especially if you can pull the data via open banking pretty seamlessly.
One of the interesting themes in your business over the last few years has been the approach that policymakers have taken it. Ironically enough, the European Investment Fund, you closed a deal after a few years of working with them the very week that British voters chose to separate from the European Union in June of 2016, and that's when that £100 million tranche came from the European Investment Fund onto Funding Circle's platform to go out to UK SMEs. The British Business Bank has also put £100 million to work on the Funding Circle platform. What are you hearing from policymakers when it comes to using this model to get money out, to get credit out to small and medium-sized businesses?
Well, I think we've got, as you said, the British Business Bank lends through us, German State Development Bank, KfW as well. I think policymakers are generally pretty frustrated with their ability to get money directly into the real economy. Again, it comes back to this point where a bank like Barclays has a £1 trillion balance sheet. They might have 10, 12 billion of small business loans. You have to provide funding to the entire Barclays balance sheet, or I don't keep picking on Barclays, but someone else, RBS, whatever. You have to provide funding to the entire balance sheet, and then ask, please lend some money to small businesses. We'd like to stimulate the real economy, even though actually capital requirements work the other way. So there is definitely a sense of frustration and looking for alternative ways of stimulating the real economy. And that's why I think they've been, particularly the British government, has been so encouraging of platform-type models. The British Business Bank is a big supporter of all alternative lenders, balance sheet or platform. Because ultimately it's just about choice. 80% of lending in the UK is done by 4 banks to small businesses. In the Netherlands it's even worse, it's 3 banks. So we are completely reliant on a small number of institutions to stimulate 60% of the private sector workforce. So I think there's a lot of there's a really good move by policymakers to try and lend even more through these platforms.
Yeah, I think that's one of the fascinating themes to come out of a story that started 8-9 years ago, and be very interesting to see how that develops in the years to come. Please join me in thanking Samir Desai, the co-founder and CEO of Funding Circle.